top pick number 1, United Rentals.
So we believe that next year, again, will be another strong year for the U.S. economy and for the global economy. We want to own things that benefit from corporate and business optimism. We think capital spending will be a significant theme, and industrial will play a part. United Rentals in 2 main businesses. They rent equipment and machinery to industrial companies, and of course they rent construction equipment out to non-residential construction companies. So this is a prime beneficiary of a stronger U.S. economy. It's a company that has a relatively high tax rate, so they benefit from the tax plan. And it's a company that benefits from the theme where companies don't necessarily want to spend all the money on their equipment. They want to pay for it on an ongoing basis, so it's a capital light theme. And so long as we think the economy is improving, we want to own things that benefit from capital spending, and United Rentals fits into that theme.
Comerica Incorporated, one of these regional banks?
Yeah, I've talked a lot about financials. The regional banks are the biggest beneficiary of the tax plan. Comerica is a $70 billion U.S. regional bank, $70 billion in assets. Next year, the CCAR limit will rise up to $200 billion, so they will not have to go through the CCAR process. Very expensive. Compliance costs for them are coming down as deregulation hits. They're a big beneficiary from lower tax rates. There is improved commercial lending going on in the U.S. They benefit from that. And again, it's a play on the U.S. domestic economy, and the regional bank sector looks very attractive. You could buy the whole sector by KRE.
KRE.
Or you could buy Comerica and a few other regionals that look very attractive, but I think this is a long legs to this theme. And rising rates means that their net interest margin goes up. 90% of their loans are floating rate loans.
So that's good. They don't have these grandfathered low yielding loans.
That's exactly right. Yeah. So as rates go up, they make more money.
Okay. And another financial is your third top pick, Charles Schwab.
Yeah, we've talked about asset management, we've talked about capital markets, regional banks. Now we'll talk about Charles Schwab in the discount area. Retail and private investors are becoming more engaged with markets as markets are improving. $7 trillion in wealth created last year in the U.S. Schwab has about 10 million accounts. They're opening 100,000 new accounts a month. So 1% growth a month, not so bad. Their asset management and advisory business is growing very nicely. They have about $3 trillion in client assets, and they hold a tremendous amount of cash. As rates go up, the margin that they make on that cash being deployed is very, very good. As people buy more equity-like products, the fees that they generate go up. So again, we want to own things that benefit from stronger capital markets. And of all of the companies in this industry, Schwab is the most client-friendly. And so they really are sort of hitting on that Amazonization of businesses, making it easy for people to do business.
And just remind us of your thesis when we do see higher interest rates, and the Fed is expected, once again, very shortly to raise interest rates. What does that do to the financial sector?
Well, it's the sector that wins the most by rising interest rates, not just short, but long-term interest rates, are the financials. Because if you hold cash balances on behalf of your customers, you make a spread, what you pay them versus what you're making on the money. So as rates go higher, their spread gets better. So in the U.S. banks, historically, they made a lot of money holding client deposits. When rates went to zero, you may remember they didn't want to hold deposits. They couldn't make any money on it. They wanted people to take their money back. So for Schwab, money moving into active and equity-like strategies is improving. That's better margins. Deregulation is good for them. Lower tax rate is good. They pay a 35% tax rate, which of course is going to come down a lot with the new tax plan. So these financial services companies have a lot of tailwinds that are going to go on for many years, and they are relative. They're the least owned sector by hedge funds and investment managers in the U.S.
David, thanks very much.
Thanks for having me.
David Burrows has been our guest on Market Call. Thanks for watching. The Encore airs Monday through Friday, 10 p.m. Eastern, 7 o'clock Pacific. Market Call tonight, Monday through Friday at 5:30 p.m. Thanks for watching once again, and we'll be back tomorrow.